What's up, traders? Today I'm going to show you exactly how the wheel strategy works with illustrations, because if you're anything like me, you're a visual learner. But if you're new to the channel, my name is Rashad. I am a full-time six-figure options trader, and I use the money I make from trading options in order to pay for my lifestyle, along with my wife's and our 6 kids. Yes, I said 6 kids. But with that being said, let's get down to business. Now, there are 2 main option trading strategies that the rich and wealthy use, and one of them is called the wheel strategy. Now, the wheel strategy is a combination of 2 separate option strategies combined into one. And as you can see here, the first step is to sell a put. The second step is to get assigned, aka buy the shares. The third step is to sell a covered call. And the fourth step is to get your shares called away, which means you're simply selling the shares. But let me give you a further description of how this works as I illustrate this for you. So let's say we have stock ABC and it's currently selling for $100. So ABC stock selling for $100. Now, like I said, the first step would be to sell a put. So step number 1. Sell put. Now, when you sell a put, you're essentially selling insurance for a stock. So you would go to the buyer, let's say his name is David, say, hey, David, I see you own ABC stock, and if you would like some insurance on it, I will buy it from you at, let's say, $90. But for doing so, you have to pay me $125. And then David kind of thinks about it and he goes, all right. So David pays you $125 right here, right now, as insurance for his stocks, just in case they drop to $90. But here's the thing, your contract only goes for, let's say, in this case, 30 days. So here's an illustration of that. All right, we have this stock here, and we wanted to sell the put at $90. Now, the stock is currently trading up here. Now, throughout that 30-day time period, as long as the stock's price stays above the $90 by the end of the expiration date, we just keep the money we received and we go about our life. And what's even better, we can do that over and over and over and over again and keep collecting that $125, or sometimes even more, sometimes less. You know, it's pretty much no different than your car insurance. You pay your car insurance every single month, whether you get into a crash or you don't. But most of the time, you never get into a crash. And that insurance company keeps the premium that you pay them every month, whether you get into the crash or you don't. Well, that's the same thing we're doing with selling puts. The majority of the time, that stock will not drop down to your strike price. Okay, so with this step, you can continue to sell puts over and over again. I've sold puts on some companies for several years and never got assigned once. You literally just get paid to wait and do nothing. So you can do step 1 over and over again. But what if the stock's price drops below your strike price by the end of the expiration date? Well, this is how that will look. All right, so if we come over here, let's do another table. And we sold our put at $90. And let's say the stock price moves, and by end of expiration date, it is under our $90 strike. Well, now we have to purchase 100 shares of the stock at our strike price. So we'll purchase 100 shares of ABC stock at $90. Now, we still get to keep that $125 that we were paid for doing the contract. So you get to keep the money regardless of if you're assigned or not. But in this case, we were assigned, and being assigned is step number 2 in the wheel strategy. So number 2 over here is get assigned. Well, once we're assigned, we now own 100 shares of that stock per contract that we wrote. Well, there's nothing much more to that step. Now we can move on to step 3, which is sell covered calls. If you found this information helpful, I would love if you came and joined my community called Trade to Freedom. If you're tired of the 9 to 5 and you're looking for a way to create sustainable income every week and every month, then Trade to Freedom is for you. This community and course will teach you everything you need to know about options. No fluff, just real strategies that work. The exact strategies that I've used in order to bring in multiple 6 figures every single year from the stock market. And with direct access to me and my live trades in real time, you'll get the actual trades that I'm using in order to make money for my family and I. You'll have the support you need to turn this knowledge into real results. It's not just a community and course, it's a path to financial freedom. And I'll be with you every step of the way. So step number 3, sell covered calls. So now that we own the shares at $90, we can now sell a covered call for any price of $90 or above to make profit. So in this case, let's say we're going to sell covered calls at $105. So we will sell a covered call at $105. Now this time as a seller, you're going to the buyer and saying, hey Sam, I have these shares and I will allow you to take them from me at $105. However, if you would like to do so, you have to pay me $150. And Sam is interested in this because he likes the stock and he's able to use leverage because him paying $150 is much less than having to buy 100 shares of the stock. So he's willing to pay that just in case the stock that he likes goes up by a lot. But we as the sellers are fine with letting go of our shares at that price. So after much thinking, Sam goes, all right. And he pays us the $150. Okay, so same thing as before. The first scenario could be, oh, our stock moves, it moves, and by the end of the expiration date, it is trading right below that $105 strike. Well, just like before, we keep that $150 in premium that we received, but in this case, we still own all of the shares that we had before. So now we get to sell another covered call again. You know, it's very similar to owning real estate. If you own rental real estate, you own a home, a property, and the tenants pay you every single month for occupying the space. Well, in this case, it's the exact same thing, but instead of a property, it's a stock. And I'll tell you, I own rental property, and owning stock is a lot less stressful. I'll tell you that for sure. So again, with that step, we can do that over and over and over and over again, just like with step number one. But what if the stock's price rises above our strike price by the end of the expiration date? So same thing as before. Let's draw our table and we have our strike up here at $105. All right, so this case, the stock moves, and it finishes above our strike price by the end of the expiration date. Well, this is great. One, we will get the capital appreciation from the stock going from $90 that we bought it at all the way up to $105. And on top of that, we still keep that $150 that we received. But now once that happens, you're on to step number 4, which is sell your shares. So step number 4, sell shares. And that is the will strategy. And it's called the will strategy because you can continue to do that step over and over and over and over and over again in a nice little circle, just like a wheel. Well, folks, that is the will strategy. That is a strategy that all of the millionaires and huge hedge funds run every single week and month. But if you would like to trade with me and see my exact trades in real time, please join me in the Trade to Freedom community and earn passive income with us. I'll see you guys in the next video. Peace.